Yeah. Today we are going to be dissecting the concept of business valuation. We discuss the introduction to valuation, reasons for valuation, methods of valuation, and then, of course, requirements, basic requirements for valuation. And thereafter, we are going to have illustrations. Let's start with the introduction. What do you understand by valuation? Simply put, we can say valuation, okay? Valuation represents. Please kindly mute yourself. I don't want any background noise. It distracts me, please. Valuation represents the process of determining the economic worth, okay? The economic worth of a business or a company's share. So when you want to determine the market value of a business, that means you are carrying out valuation. All right. It is also possible you may want to determine market value per share, or you want to determine the share price of a company. All right. The process of doing that is what is known as valuation. All right. Now, there are different purposes of carrying out valuation, or you can say valuation can be carried out for different purposes. All right. Including at this level, the examiner can ask you, what are the reasons for valuation? Number one, we can carry out valuation for the purpose of merger and acquisition. All right. So when two companies intend to merge together in order to become a bigger company, all right, so there will be need to value the individual business, okay, in the business combination. Company A and company B are coming together to become company C or company AB, right? Therefore, you need to know, as of today, what is the worth? How much is my worth as company A? Company B will also need to determine its own worth before you now determine the worth of the combined businesses. All right. So that is one of the reasons for valuation. Okay. Under acquisition as well, when a company acquire controlling interest more than 50% in another entity, so the acquiring firm, all right, the company that is acquiring another company, we need to determine the value of that company that is targeting. All right. So that is one of the reasons for valuation as well. Number two, you're also carrying out valuation for stock exchange listing. All right. Stock exchange listing simply means is that when a company is going for initial public offering, maybe a limited liability company wants to go public. So for you to be able to determine in order to know how much your share price will worth, we need to determine the value of the business, the entire business, so that you'll be able to know how much um, the market will pay for your shares. So stock exchange listing, all right, is another reason for valuation. Number three, we also carry out valuation for the purpose of litigation. All right. So litigation can arise as a result of disagreement between parties. There could be a disagreement between companies, or between company and contractor, or between principal and the agents. So when there is litigation, so the court may decide that you should value the business in order to determine the claim settlement from the property. All right. Then number 4, you also carry out valuation for the purpose of liquidation. All right. So when a company liquidates, the assets of the business will be disposed of, and the proceeds therefrom will be used to settle the creditors. Therefore, before the business is being sold, or the business assets are being sold, you need to determine the worth of those assets so that you'll be able to know how much to sell it to prospective buyers. All right. Then number 5, we also carry out valuation uh, for the purpose of loan
Ruth,
facility.
Ruth, let me check that table. There's a ruler there. Let me bring it.
You people don't follow simple instruction. I've told you to always mute yourself. So you also carry out valuation for the purpose of loan facility, right? Depending on the size of the loan. If a company, for example, a company that requires a loan of 100 million naira, your bank or lender will not just give you the loan without asking you. You want to know what is the value of your business in order to know how much you can support. Because the value of a business will enable your prospective lender to determine how much you can support from the business for the loan that you want to take. Then number 6, you also carry out valuation for where there is marital disputes, okay? Marital disputes. For the purpose of marital dispute. This is not common in Nigeria, particularly in Africa, but in the Western world, of course, it's very common, particularly among the VIPs, the very important personality among those wealthy people. All right. For example, most of the world's richest people today, some of them they have divorced that they have at one point in time in the past, they've divorced. For example, Elon Musk, all right, Jeff Bezos of what's it called? This e-commerce platform. I usually forget the name, So almost all of them, all right, even Bill Gates, they've all divorced in the past, whereby the court will decide that, okay, we determine the worth of individual partner in the relationship in order to know how much of your estate will go to the other party. All right. Any of the party that has a higher worth is the one that the asset will be shared or the estate will be shared, depending on the ratio determined or the agreed ratio between the two parties. Then another reason for valuation is where there is shareholders and shareholders or partnership disputes. All right. We also carry out valuation for the purpose of shareholders or partnership disputes. Okay. Now, where there are unresolved issues between or among partners in a partnership business, the partners may agree that it's better we dissolve the partnership business so that let's share the assets of the business. After we have settled the liability, let's settle whatever we have thereafter. So you need to know what is the worth of the business in order to determine how much will be attributable to each partner in the partnership business. All right. So, of course, we also have for estate and tax purposes. So, but for because of time, these are some of the uh, reasons or purpose of carrying out valuation. Okay. Then let's talk about methods of valuation. Okay, methods of valuation. Basically, there are so many methods. There are several methods of valuation, but I'll break it down. Some of them are what we are going to discuss. Okay, number one, we have asset-based approach. Asset-based approach. Your syllabus says you should have a simple business valuation. There's no merger and acquisition in your syllabus. So you have a simple business valuation. So of course, when you get to professional, you are still going to be doing this. So we also have income-based approach. Then number three, we have discounted cash flow. Discounted cash flow based approach. All right, so let's talk about each of them. The first one is asset-based. I'm going to shorten my notes so that we can go far. Asset-based approach. Okay, what do you mean by asset-based approach? This is a method of valuation. This is a method of valuation that relies heavily. Okay, this is a method of valuation that uses or that relies heavily on the use of net assets in the determination of the value of a business. Okay. When valuing a business or the value of a business, the value of a business using asset-based approach, represents the net assets. Let me put it in capital letter. Represent the net assets. Okay. So when you want to value a business using asset-based approach, just go ahead and calculate net assets. So that will give you the worth of the business. All right. The net assets or net assets is the difference. Between total tangible assets and total liability. Total liabilities. Okay. Remember, tangible assets are those assets that can be seen, touched, or move around. For example, motor vehicle, right? Plant and equipment, machinery, furniture and fittings, land, then building, all those things, they are tangible assets. Intangible assets are assets that cannot be seen or move around. You can't touch it. All right. So when valuing a business using asset-based approach, okay? When valuing a business using asset-based approach. Intangible assets such as goodwill, patent rights, copyrights, etc. should be ignored or should not be included. Should not be included except they have market value. So what this is saying is that when you want to determine the value of a business using asset-based approach, if you are given intangible asset like goodwill or copyrights, you are going to ignore it. You are not going to include it as part of your calculation. However, if in the question you are given the market value of the intangible assets, you have to include it as part of your assets. So that's the implication. All right. What are the forms of asset-based approach? Forms of asset-based approach. Okay, there are 4 of them. One is book value basis. All right, the book value represents the figure given in the balance sheets. Any figures you have in the balance sheet is the book value. So if you have to use book value basis, just go to the balance sheet, pick all the figures you have here, calculate your net assets, which is total tangible asset minus total liability. That's all. It's as simple as that. Number 2 is realizable value. Realizable value basis. The realizable value is the amount at which the seller company can dispose of the asset of the business, the amount they are going to realize from the disposal of the asset of the business. That's the realizable value. All right. Number 3 is replacement value basis. All right, which represent the amounts at which the similar assets can be sold currently in the market. So if you want to buy, for example, you want to buy a motor vehicle, the amount at which you are going to buy it in the market, that is the realizable value basis. All right. Then number 4, we have liquidation or breakup basis. So this represents the amounts at which the asset of the business can be disposed of at breakup basis. All right. So when a company, when a company is under distress, the amount at which you are going to sell your assets or the asset will be disposed of will be different from the market price. For example, if you say you want to travel now, if tomorrow you want to travel out of Nigeria and you want to sell some of your assets, maybe for example, you have motor vehicle that you are using, you have a TV or any equipment at home that you want to dispose for you to be able to raise money. Because people are already aware that you are traveling, the amount at which they are going to be pricing those assets, you will even marvel. You will marvel. All right. So at liquidation, when a company is under distress, people will know that this company is going through a lot. Therefore, you see them pricing the asset at a ridiculous price, at a ridiculous amount. But in any case, these are forms of asset-based approach. In any of the cases, all you need to do is to just calculate your net assets. That's all you need to do. Just calculate net assets. And you know that net asset is equal to total tangible assets minus total liability. So like I said, using asset-based approach, the value of a business equal to net assets. That's all. Just go ahead and calculate net asset. It's as simple as that. So we'll come back to this one later on when we begin to solve question. The second one is income-based approach. Income-based approach. Under the income-based approach, we have price-earning ratio, ratio, basis. Number two, we have dividend yield, basis. Then number three, we have earnings yield. Basis. So these are the three basis of valuation under the income-based approach. Yes, Chika, what's your question?
Please, sir, can you just go up a little bit so I can check something?
To do what?
There's something I missed. Just up.
I
The
wish
forms of
Nashibe,
asset base.
I will share the notes.
Okay.
If I told you I will share the notes, so that will slow me down. When I'm done, I will share with you so you can form your own notes. All right. So price earnings ratio. Now, what do you mean by price earning ratio? All right. So price earning ratio represents the ratio of share price to earnings. The ratio of share price to earnings or to earnings per share. Who is that person making noise in my class? Lanre, Comfort, you have mute yourself now. All right, so price earning ratio represents the ratio of share price to earnings or earnings per share. All right, so the value of a business, using price earning ratio represents, or the value of a business using price earning ratio is determined by multiplying the P ratio, the price earning ratio, with the earnings, with the earnings. Okay, that will give you the value. PE ratio, let me give you the paragraph. PE ratio can be used to value any company, provided that the company is profitable, provided that the company has a profitable history. So only a profitable company can use PE ratio, and the company must be quoted. So this simply means that any loss-making company will not be able to use PE ratio. However, However, PE ratio is not available. It's not available for companies. For companies that are not quoted on stock exchange. Okay, they are not available for any company that is not any limited liability company. We not have price earning ratio. Therefore, when you value an unquoted company, when you valuing an unquoted company, the P/E ratio of a comparable quoted company should be used and adjusted downwardly between the ratio of 10% and who is this person calling me by this time? Between the ratio of 10% and 50%. All right, depending on the perceived risk. Depending on the perceived risk associated with a limited liability company. With that, depending on the perceived risk associated with the unquoted company. All right. So what we are saying here is that anytime you want to value a limited liability company using the price earning ratio, all right, a limited liability company does not have a P/E ratio. So all you need to do is to borrow the P/E ratio of a listed company. For example, in the banking industry, not all the banks are quoted, even though they are operating in the same industry. For example, Gitco is quoted, right? Skybank, do we still have Skybank? Okay, let's say, let's say, of course, Globus Bank, for example. Globus Bank is a limited liability company, it's not quoted, right? Therefore, if you want to value Globus Bank, for example, you need to borrow the P ratio of a comparable quoted company. But as basis of your valuation, you cannot use the exact P/E ratio of a quoted company to determine the value of an unquoted company. When you do that, that means you are assuming that both the quoted company and unquoted company have the same business risk, which is not true, right? Because the risk of an unquoted company is more than the risk of a listed company. And that's why you have to adjust the P/E ratio of a quoted company downwardly between the ratio of 10 and 50. So on the day of your exam, the percentage or the proportion of adjustments on the P/E ratio will depend on the perceived risk that you think. A student can assume 10% adjustment. That means you are going to apply 90% on the P/E ratio. Another student can assume 15% risk. That means you are going to apply 85%. Another student can assume 30% risk, then you apply 70% on the P ratio. So it depends on whatever you have assumed to be the adjustment is what the examiner will mark for you. But what is important is that you just have to state your assumption. That's all. That's all you need to do. Okay? So that is for PE ratio. So I now said the value of a business using PE ratio is calculated as PE ratio multiplied by earnings. Now, the issue now will then be on the day of your exam. If you want to use PE ratio, examiner will not just give to you earnings. Earnings is the same thing as profit after tax. All right. This profit after tax will be given in the question under your income statement. But the challenge is that there's likelihood you are going to make an adjustment. There's probability that you are going to make adjustment on the earnings because the earnings is there in the question. Examiner cannot just say, okay, the P ratio will also be there. Just adjust for the P ratio. Maybe you take 70%, 80%, 90%, 95%, whatever the percentage adjustment. You just multiply with the earnings. So in the question, examiner will always tell you that you need to adjust for your earnings because when companies is preparing the statement of profit or loss accounts, they carry out a lot of, they tend to be creative. All right, they tend to be creative in their earnings management. They can increase the operating cost, for example, for the purpose of reducing tax liability. All right, they can defer some expenses or they delay they delay recognizing expenses in their profit or loss account in order to achieve a targeted goal. So all of these things are what companies usually do to manage their earnings, and their reported profit. So examiner will give you that scenario. So you now have responsibility to be able to make adjustments on your earnings before you determine the value of the business. All right. So this is the formula for calculating the value of a business using the PE ratio. So let's move to the second one, which is dividend yield basis. Okay. Dividend yield basis. Okay, dividend yield basis. What do you mean by dividend yield? Dividend yield is the ratio of dividend to share price. It is also known as cost of equity. Okay, it is also known as cost of equity. The value of a business all right, the value of a business using the dividend yield basis, using dividend yield. Let me write that. Using dividend yield represents the present value of future dividends discounted using dividend yield or cost of equity. Okay, so that is the value of a business. Okay, so the value of a business can be calculated using the formula above. the formula below can be used to calculate the value of a business using dividend yield. Okay, depending on whether depending on whether or not there's growth in dividend payments. So number A, where there is no growth. So where there is no growth in dividend. So if you are not given growth rates, we can say dividend yield which is also known as cost of equity, is calculated as the current dividend divided by share price. You remember this formula that we use, all right? So this is dividend yield. In case in the question you are not given dividend yield, so the information will always be there for you to be able to estimate it before you then determine the value of the business. All right. So this is how, so when you are asked to calculate dividend yield, like I said, is the same thing as cost of equity. So this denominator, which is share price, is the market value per share. So you now want to determine the value of the business, meaning that you need to cross multiply, just cross multiply. That will give you the market value. So the market value, the value of a business using dividend yield is computed as the ratio of dividend over dividend yield over dividend yield. That's it. That's it. It's no more than this. This is the value of a business where there is, using the dividend yield basis, where there is no growth. Number B, where there is growth. Where there is growth in dividend. Okay? Where there is growth in dividend, and you are asked to calculate dividend yield, or you want to calculate dividend yield, dividend yield will then be equal to the current dividend multiplied by 1 plus the growth rate divided by share price plus the growth rates all multiplied by 100%. So this will give you the cost of equity or dividend yield. If you now want to determine the market value of the company using the dividend yield where there is growth, that is, you want to make this denominator the subject of the formula. In this case, dividend market value will be computed as dividend multiplied by 1 plus the growth rate all over this guy. This dividend yield will come down, become the denominator. So all over dividend yield minus the growth rates. All right, so this is the formula for calculating the market value of a business where there is growth. Okay, where there is growth in dividend payments. So that's that. It's not more than this. All right, then number C, earnings yield. Earnings yield basis. This is similar to dividend yield. All you need to do is to just replace dividend with earnings. That's all. Okay. So what do you mean by earnings yield? Earnings yield is the ratio of earnings to share price. All right. The value of a business using earnings yield basis represents the present value of future earnings discounted using earnings yield. Discounted using earnings yield or rate of return. Rate of return on equity. All right. So again, if you want to determine the value of a business or you want to calculate earnings yield, so where there is no growth, in earnings. So in this case, because there is no growth in earnings yield will be computed as earnings all over share price multiplied by 100% where there is no growth. That's how to calculate earnings yield. Therefore, the market value where there is no growth will be equal to earnings divided by earnings yield or rate of return on equity. All right, so that's the formula. Where there is growth, in earnings, so earnings yield will then be calculated as earnings. Remember what I said, earnings is the same thing as profit after tax. So where there is earnings yield will be computed as earnings multiplied by 1 plus growth rates divided by share price plus the growth rates, all multiplied by 100%. All right. So where there's growth, market value will then be calculated as earnings multiplied by 1 plus the growth rates divided by earnings yield minus the growth rates. This is the formula for calculating the market value of a company using the earnings yield. So these are the three. I've explained the three methods of valuation under the income-based approach. When we have illustration, we see how we are going to compute each of them, live and direct. So the last one is discounted cash flow-based approach. So we have discussed the asset-based approach. We have discussed the income-based approach. The last one is discounted cash flow-based approach. Quickly, let's talk about that before we begin calculation. These are fundamentals, what we are doing at the foundation to building or to valuing a business. You need to know all of this first. Okay, so the last one is asset-based. approach. Sorry, what did I say? Cash flow. Discounted cash flow based approach. Let me see. What did I use? I think I'm using too much ABC. Let me adjust for that. I call this one number 1. This is number 2. Then this is number 3. To avoid confusion. Then the income base, that's ABC already. Let me use capital letter. Or let me use Roman figure 1, Roman figure 2. All right. Then this one will then be Roman figure 3. Okay. To avoid confusion. All right. So discounted cash flow based approach. So the discounted cash flow based approach is the most sophisticated method of valuation. Is the most sophisticated method of valuation. Let me put it down. This is the most sophisticated method of valuation. Okay, it is a method that relies on the use of free cash flow. It is a method that relies on the use of free cash flow for the purpose of valuation. For the purpose of valuation. So what do you mean by free cash flow? Free cash flow is the cash flow available for distribution to the providers of capital, including shareholders. Ordinarily, let me put it as equity holders, including equity holders and debt holders. After payments or after considering all cash outgoings, that is cash outflows, including capital expenditure, needed or required to support the business operation. So that is free cash flow. What are the types of free cash flow? Types, in fact, I'm almost so I need to, I think the note is sufficient. Let me shorten it. Types of free cash flow so that we can cover much. We don't have time again. After today, we only have one more class. So types of free cash flow. All right. Number one, free cash flow to the firm. Free cash flow to the firm. FCFF. Then number two, free cash flow to equity. Free cash flow to equity, which is FCFE. So let's talk about each of them. Free cash flow to the firm. All right. So what do you mean by free cash flow to the firm? This is the cash flow. This is the cash flow available for distribution to equity holders and debt holders. It is useful. What do you use free cash flow to the firm for? It is useful for determining the value, for determining corporate value. Let me put it that way. So determining corporate or enterprise value. So when you want to determine the market value of a business, you can use free cash flow to the firm. All right. So how do you then calculate free cash flow to the firm? So I will only give you two out of two formats. I will only give you one. Then if you have the golden book, you can pick the second format there, depending on the information available. We don't have time. So I will come here free cash flow to the firm. Free cash flow. Let me put it format first. So free cash flow to the firm. Now, depending on the information available, you can calculate free cash flow to the firm starting from profit after tax or profit before interest and tax, whichever one that you are given. So I can say starting from, please, on the day of your exam, when you are calculating free cash flow to the firm, don't go and be writing starting from. It's because of your own understanding. That's what I'm putting starting from. So if you want to start from profits before interest and tax, for example, don't forget what I said. Don't go and be writing starting from. Nobody ask you. All right. So you want to start from profits. Let me write it out in full. Who is this person writing on my screen? Adewale, why are you messing up my screen? Stop it. So profits before interest and tax. So you go to the question, you pick it. After process, remember what we said. The free cash flow to the firm that you want to calculate is available for distribution to equity holders and debt holders. So what that simply means is that anything that has to do with equity holders and debt holders, you are not going to include it in your free cash flow to the firm. For example, the debt holders is entitled to interest. So interest expense in your income statement, you are going to ignore it. Any loan repayment or proceed from debt issues, you are going to ignore it. So anything that has to do with the debt holder or dividend that has to do with equity holder, you ignore it. So you don't do anything with it. You don't include it in your free cash flow, because the free cash flow to the firm that you want to calculate is what you are going to share between the debt holders and then equity holders. So immediately after the profit before interest and tax, you need to pay tax. You charge tax. How do you calculate your tax? Tax is profits before interest and tax multiplied by company tax rates. So be less. There's no need for you to find the difference. Just go ahead with your calculation straight. After this, you need to consider non-cash item like depreciation. You add back depreciation or amortization or even provision. You add it back. Then you consider if you have increase. I usually call it changes in working capital. Okay, you consider changes in working capital. If your working capital decreases, that means there's a cash inflow. If your working capital increases, there's a cash outflow. You put it in brackets. Okay, then you consider capital expenditure on non-current assets. It is possible that the company wants to purchase non-current assets. So that's cash outflow. So you put it there. It's a cash outflow. So at the end of the day, you determine your free cash flow to the firm. So this is one way of calculating it. All right. So, but at times in a question, you may not be given free cash flow. You may not be given profit before interest and tax. Examiner may give you profit after tax. So if you are given profit after tax, how do you then calculate? And I said I'm going to give you only one format. Anyway, free cash flow to the firm. If you want to start from profit after tax. The reason why I'm explaining all of this is that depending on the information available, you can calculate it anyhow. So the information available will tell you how your starting points. So at times in a question, in the income statement given to you, examiner may not give you profit before interest and tax. You only see profit after tax. So in that case, you then be looking for profit before interest. Where is this profit before interest and tax? So, but in any case, starting from profit after tax, I will go to the question and pick it. Remember, before they arrive at profit after tax, they have already deducted interest expense. They have deducted taxation. They have deducted depreciation. So all those expenses, like interest, for example, you need to add it back. I will then come here, net interest. This should be computed as interest multiplied by 1 minus tax rates. So you add it back. Okay. So the next one is to add back a non-cash item like depreciation or amortization. You add it back. You consider changes in working capital. If your working capital decreases, it's a plus. If your working capital increases, more cash has gone out, so it's a minus. Then you consider capital expenditure. It's a cash outflow. So this will give you free cash flow to the firm. So these are the two formats that you can use to calculate free cash flow to the firm. Then the second one is free cash flow to equity. Free cash flow to equity. Let's talk about free cash flow to equity. Number two. Let me call it B. Free cash flow to equity. So what do you mean by free cash flow to equity? This is the cash flow available for distribution to equity holders. All right, this is the cash flow available for distribution to equity holders. Okay, it can be used for determining equity value. So when you want to determine market value of equity, you use free cash flow to equity. All right. So how do you then calculate free cash flow to equity? There are three different formats that you can use depending on the information available. If in the question the examiner asks you to calculate free cash flow to the firm, and you are then asked to calculate free cash flow to equity, or maybe examiner has given you free cash flow to the firm, you are now asked to calculate free cash flow to the to equity. In this case, I can say free cash flow to equity starting from starting from free cash flow to the firm. All right. If you want to start from free cash flow to the firm, then you then come here, free cash flow to the firm as computed above. You pick it. Remember, we said that free cash flow to equity is available for distribution to equity holders. Now, this free cash flow to the firm, you have already, you want to distribute it. You must first of all settle the debt holders before the equity holders. Therefore, from the free cash flow to the firm, you are going to pay interest. So this will be net interest. So you come here, this will be interest multiplied by 1 minus tax. So you less. It is also possible in the question you are going to be given loan repayments. Maybe part of the loan that the company has borrowed, the company wants to pay back. When you are paying loan, your cash will be going out. So that's a cash outflow, put it in brackets. It is also possible that the company has borrowed another entity loan, and those entities are now paying back. That means cash is coming in. That's what we call proceed from debt issued. You have issued out debts. The debt holders are now paying back. All right. So, the issuers are now paying back. So you then, of course, it's a plus. So when you sum it up, that will give you free cash flow to equity. So this is one way of calculating free cash flow to equity. You can also calculate free cash flow to equity. Let me give you one more out of the three. starting from this one should I use? Let me use profit before interest and tax. All right, so you go to the golden book and pick the last one, which is starting from profit after tax. So I will then come here, profits before interest and tax. This is more like you are starting from the beginning. So you go to the question, pick the profit before interest and tax. This can only work. You can only use this profit before interest and tax if in the question you don't have profit after tax. Profit after tax is faster and shorter. All right. So, but it is possible you are not given the profit after tax. That's what I'm starting from, profit before interest and tax. So I will then come here. Immediately after profit before interest and tax, you need to pay interest. This interest, you are not going to make any adjustments. All right, so this will then be profits before tax. You then charge tax. Tax will be profits before tax multiplied by company tax rates. So no need for you to find difference. Just add back non-cash item. Depreciation or amortization, you add it back. You consider changes in working capital. If your working capital reduces, that's a plus. If your working capital increases, more cash has gone out, then you consider whether additional non-current assets has been purchased. So capital expenditure is a cash outflow. Not only that, you also need to consider if there's any loan repayments. Okay, if there is loan repayments. So if the company repaying loan, that means cash is going out. Put that cash outflow, put it in brackets. If there is any proceed from debt issued, cash has come in, that's a plus. Then, of course, you determine your free cash flow to equity. So this is another format of calculating free cash flow to equity. You use this one if you are starting from profit before interest and tax. The last one is starting from profit after tax. So go and pick it in the golden book. All this format is not in any textbook. It's only in the golden book you can find it. All right. So let's move on from here. Lastly, let's talk about uses of free cash flow. Uses of free cash flow. What do you use free cash flow for? Number one, you can use free cash flow to determine the value of a business. Okay? Valuing, let me put it this way, free cash flow can be used for one, valuing a business. If you want to determine the market value of a business, you use free cash flow. Number two, you can use free cash flow to pay debts. You can use free cash flow to pay dividends. You can use free cash flow to determine dividend capacity. Okay, dividend capacity. You can use free cash flow to undertake expansion, okay? Because the cash flow is free, it's available. You can use it for expansion purposes. All right. So for this purpose, what do you know? What is dividend capacity? Note, After this, we should have illustration. Note, dividend capacity is the ability of a business or of a company to pay dividends from the cash flow available for distribution to equity holders. Okay, so that's dividend capacity. It can be computed as follows. So if you're asked to calculate dividend capacity, so dividend capacity is the ratio of free cash flow to equity to dividend. So this is free cash flow to equity over dividend. So it will be expressed in times. Okay. So when you calculate your free, you want to know how many times does your free cash flow to equity cover dividend? All right. So that is free cash flow that is dividend capacity. Now, I don't want to go outside your syllabus because examiner has told in your syllabus, examiner said that you are going to have simple business valuation. And because merger and acquisition is not part of your syllabus, so I may not talk about business combination, how to value a business using, how to value a business combination transaction using the free cash flow. So we're not going to discuss that. However, possibly, maybe after our class, I can just share a note or a video for you to watch just in case. But it's not part of your syllabus. I don't want to go into that. But in any case, this is what you are going to do. So when you now want to value a business, when you want to determine the value of a business using free cash flow, all you need to do is to calculate the present value. All right. So the value of a business, the value let me put it this way. Calculating corporate value. Let me put it that way. Calculating corporate or enterprise value. There are two stages using free cash flow. Step one, calculate the present value. Calculate the present value of the initial period. All right. The same way we normally calculate present value. After you have determined the free cash flow, just discount the free cash flow at the appropriate cost of capital. So you then add everything together. That will give you the present value of the initial period. The initial period is, let's say, for example, you have to value the business for the next 3 years. That 3 years is the initial period. It could be for 4 years, it could be for 5 years. All right. Then step two, you determine present value to infinity. Calculate present value to infinity. This is because the business infinity. So this is because the business is seen to continue in operation for the foreseeable future. It's not just about the initial period. If the initial period, for example, is for 3 years, so the assumption is that the business will continue in operation for the foreseeable future. for life. So you are going to determine market value for the initial period, for the first 3 years, for example. Then after year 3 is year 4. So from year 4 for life, from year 4 to infinity, you also need to determine the market value of the business. Then step 3 is to now calculate the total present value. Calculate total present value, which is step 1 plus step 2. Now, before that, let me give you the formula to use for this step 2. All right. So PV to infinity. PV to infinity will be calculated where there is, okay, let me do this way. Let me move to the next line. Number A, where there is no growth. So where there is no growth, present value to infinity will be calculated as free cash flow of the base year divided by the cost of capital, okay, divided by the cost of capital, maybe WACC, multiplied by discount factor of the base year. Let me write that. Discount factor of the base year. So this is the formula you are going to use to calculate market value to infinity where there is no growth. Number B, where there is growth. Where there is growth in cash flow. Then present value to infinity will be computed as free cash flow of the base year multiplied by 1 plus the growth rate divided by the WACC minus the growth rate multiplied by discount factor of the base year. So this is the formula that you are going to use where there is growth. Note, FCFB equal to free cash flow of the base year. All right. Then, of course, G equal to growth rates. Then DCF, DCBY, this discount factor of the base year. You can see all what we are doing since they are just explanation. It's more than this. I think you have business combination as part of your scope. You have merger and acquisition as part of your scope. We still have a lot to discuss. Scenario 1, scenario 2, scenario 3, and what you need to do under each of them. So valuation is not a child's play. All right. So we then move to step 3. Step 3, we then calculate total present value. Calculate total present value. That is step 1 plus step 2. Step 1 plus step 2. That's a total present value. PV of step 1. Let me rewrite it. Step 1 plus step 2. Or let me just step 1 and 2. Okay, so that's that. That's all you need to do. This is just for simple valuation. Let me know if you have any question for me. At this point, let's have an illustration. If I can solve 2 or even more illustration today, so that's fine. Let me know if you have any question for me. If not, let's begin to solve question at this point. Any other thing we need to include, we'll be doing it later. All right. So let me stop sharing this and move to the working note straight. Sorry, learning material. Okay. So go to your material and read more. Go to your material and read more. We have covered most of all of this. All right. Oh, Adibin, I know that I already have starting from profits before interest and tax. I would have used profit before profit after tax in that one. But in any case, let's move on. All right. This one is mainly for business combination. It's mainly for all this scenario. They are under business. These are the things you need to do under business combination. So it's not part of your syllabus because in your syllabus, you don't have adjusted present value. So we can't be discussing all of that here. Okay. So all this scenario two, they are under business combination. So all those things, the formula I just gave to you now, you also have it here. So you have it here. That's it. So at this point, let's have an illustration. Now, let me start with the question that involve free cash, calculation of free cash flow. Let me start from there. If we still have time after that, then we do another question that involve asset-based and then income-based approach. So let's start with illustration number 3. That is page 124. Page 124, illustration number 3. Who is helping us to read this? Yeah, one of you should help us, please. I've been the only one talking since.
Lamborghini PLC, Lamborghini Limited.
Yeah, welcome, Christiana. Go ahead. Hold on. Yeah, go ahead.
Lamborghini Limited, a food packaging company, has operated as a private company for the past 10 years. The company has been growing rapidly over the last few years. The directors are now considering listing the company on the stock market. Preparatory to this, the directors are interested in determining a fair price per shares for the company. Assume today is November 1st, 2016. The following information has been extracted from the most recent audited financial statements of Lamborghini. We have the statement of profit or loss as at October 31st, 2016 as follows. We have the statement of financial position as at October 31st. The following additional facts are available. Go up, sir. The director believed that the free cash flow to equity model should provide appropriate valuation for the company's shares. An investment banker has provided the following estimates of cost of capital. We have cost of equity to be 15%, post-tax cost of debt to be 4%, and WACC to be 12.5%. The directors believe that the free cash flow to equity will grow by 18% for the next 5 years and by 5% thereafter. The company currently has 600 million shares in issues. You are required to calculate the free cash flow available to equity for the year ended October 31st, 2016. B. Use free cash flow to equity model to calculate the current value per share. And C. What are the key advantages and disadvantages of the stock exchange listing?
All right, thank you very much, Christy. That's the question. In the A part, you are required to calculate free cash flow available to equity for the year ended 31st October 31, 2016. So you want to calculate free cash flow to equity. Pay attention, please. Now, Lamborghini Limited is going for stock exchange listing. The company wants to go public. As a result, you need to determine the value of the business. Because it's a limited liability company, you are told to calculate free cash flow to equity. All right. So there's difference between free cash flow to equity and also free cash flow to the firm. So since you want to calculate free cash flow to equity, what are you supposed to do? You go to the income statement given to you. All right. You go to the statement of profit or loss accounts. You are going to identify either profit before interest and tax or profit after tax. And I told you, if you have profit after tax, always start your free cash flow from profit after tax because it is faster or shorter relative to if you are starting from profit before interest and tax. So without wasting time, open to the question at your end. Let me switch to the working notes so that we can quickly solve the question. It's not difficult. Okay. So I will then come here, solution to illustration number, what number is that? Let me check. Number 3, page 120, 124. Illustration number 3. Page 124. All right. The name of the company is Lamborghini. Lamborghini Limited. Number A, requirements. You have to calculate free cash flow to equity. I would then say calculating free cash flow to equity. FCFE. All right. So our figures are a million. We want to calculate free cash flow to equity. How do you determine free cash flow to equity? So I said you can either start from profit before interest and tax, which is the same thing as EBIT, earnings before interest and tax, or you start from profit after tax. I then advise that you should always start from profit after tax because it is faster. So in the question, the profit after tax given to us is 1054. Remember, this free cash flow to equity is available for distribution to equity holders alone. Therefore, before arriving at the profit after tax, they have deducted interest, they have deducted taxation. You don't need to worry yourself about anything like that. So before they also arrive at this profit after tax, they have deducted depreciation. So you need to add back depreciation. So I will then come here, depreciation. Before you put down depreciation, you must confirm from the question if you have depreciation. So in this question, we are given depreciation of 440 million. So I will then come here, depreciation 440. You had it back because depreciation is not a cash flow. Before they arrive at the profit after tax, they have deducted depreciation, so you need to return it. Immediately after depreciation, you consider changes in working capital. Remember, we have a format. So we consider working capital. I will then go to the question. If I'm given working capital, examiner did not give us working capital, but in the question, we are given statement of financial position for 2 years, one for 2016 another one for 2015. So if you are given balance sheet for 2 periods, you need to watch out for movement in working capital. Remember, in IS7, statement of cash flow, there are 3 stages, there are 3 phases of your statement of cash flow. We have cash flow from operating activities, which is where you are going to have your changes in working capital. We also have cash flow from investing activity. This is where you are going to have whether additional non-current assets has been purchased. Then, of course, you also have cash flow from financing activities. You want to know whether the company has borrowed more loans. Okay, so these are the things you are going to consider. Anytime you see in a question under free cash flow, you want to calculate free cash flow, and examiner has given you information for 2 different periods. That means you have to check for movements in all those things that I mentioned. So in this case, in the statement of financial position, under current assets, you have cash and bank, you have account receivable, you have inventory. Then under non-current liability, okay, you have, sorry, under current liability, you have short-term loans. You also have account payables. So with this, we can go ahead to determine our changes in working capital, because the inventory in 2016 is different from inventory in 2015. So there's likely going to be changes. We are going to have changes in working capital. So working number 1. So let's go and do our working without going too far. Oh, I've exhausted the pages. Wow. That means I've written so much today. You can imagine. You just relax there, enjoying the class. I've been the one suffering, burning the energy to write for you. You see, life, not even a word done from you. I wish I'm in the physical class.
Well
I'll
done,
be
sir.
the one
Well
bombard.
done, sir.
Oh yeah, yeah. Now you go remember. Well done, sir. You are welcome. All right, so you can imagine if it's a physical class now, I'll just be bombarding you notes. You'll be the one writing. I can even put my shell and sit down, dishing out the
Enter,
notes to you. But
John.
that's one. Yes, ma'am.
When you do enter class, come the boom face for us. We cannot see your face, but we can hear that you have booming face for us from your voice.
What can I do?
Confirm.
What can I do? Nothing do me. Oh yeah, so let's determine changes in working capital. Christina, you are writing on my screen. Stop it. So working number 1, we want to determine changes in working capital. You want to watch, you want to consider if there's any movement in working capital. You know that working capital is different between current assets and current liability. Okay? So we want to know whether our working capital has increased or decreased. So we are going to do for 2015, we compare 2015 with 2016, then any change in each of the assets. All right, our figures are in millions. Okay, so I will then go to the balance sheets. What's the first, under current assets, what's the first asset do you have there? Yeah. Let's keep moving. What's the first asset under current assets?
Cash and bank that we have.
Cash and bank.
So when you are calculating working capital, you don't consider cash and bank. You are going to ignore cash and bank. Okay? Next one,
Receivables.
Account receivables.
receivables. In 2015, how much was receivable?
980.
2015.
980. In 2016,
1,072.
1,072. Now, in 2015, customers are owing us 980. In 2016, customers are owing us 1072. That means more cash has gone out. Customer has brought more credit from us. So they have taken more credit from us. So what's the difference between the two?
92.
Minus
92. So this 92 will be an increase in working capital. That's a cash outflow. More cash has gone out. So after receivable, what's the next one?
Inventory.
Inventories.
Inventories.
In 2015, how much was inventory?
2,078.
2078. 2016,
2,542.
2000 what?
540.
542, right?
Defense 464.
464. 464. Again, when you look at inventory, inventory is what the company is going to sell to generate revenue. So in 2015, we have inventory of 2078. In 2016, our inventory has increased. That means the company has spent more money to purchase inventory. More cash has gone out. So that's an increase. Put it in brackets. After inventory, what else?
That's all for then we'll go to total asset.
So let's go to under current liability. Under current liability, you have short-term loans, right?
Mm-hmm.
So short-term loans is not part of working capital. That will come under financing. That will come under financing. Then after that, we have payables.
Yes. 2790.
In 2015 is 27 what?
90. 2790.
92. Okay. In 2016, how much?
3,084.
3,084. Okay. So
Difference
you are
290.
owing difference of 292, right?
Mm-hmm.
Now, in 2015, you are owing your supplier or creditors 2792. In 2016, you have collected more. So more cash has come in. 282 is an additional cash that comes in. Therefore, it's a plus. When your creditors increases, that's a plus. That is more cash flow has come in. If your creditors reduces, that means you have paid part of your owings to your supplier or to your creditor. All right, that's why it reduces. But if it increases, that means you have borrowed more. More has come in. All right, so at this point, I can then determine the total change. My focus is on the total line. That's what I need. What's the total?
264 negative.
264. So here is 264 negative. So that will be an increase in working capital. Let me put it as increase. Increase. Oh, don't waste my time. Increase in working capital. So that's cash outflow. I will then come here, changes in working capital, 264 negative. So after changes in working capital, we also need to consider capital expenditure. We want to know if additional non-current asset has been purchased. So I can't determine this unless I go back to the question and check. So from the statement of financial position, I will go under the non-current assets. You will see that we have different non-current assets. We have different values for non-current asset between 2016 and 2015. That means there is a movement in non-current assets. So I will then go and do my workings. Working number 2, I want to determine if additional non-current assets have been purchased. So I will then come here, additional non-current assets. If I like, I can use a formula. If I like, I can use a table. If I want to use a formula, I will say additions equal to closing non-current assets plus depreciation minus opening non-current assets. Therefore, additions will then be equal to the closing non-current asset will be the non-current asset in 2016. How much is 2016 non-current assets? Yeah,
6224.
6224. Yeah.
6224 plus depreciation of 440 minus opening non-current asset. What's the non-current asset in 2015?
5942.
5942. So what's the addition?
722.
722.
So 722 million is the additional non-current asset purchased. So if I want to use a T format, for example, for those of you that are familiar or that are used to T formats, that's old method. I want to determine additional non-current assets using a T format. I will then come here, assets is a debit balance. So I will then say balance brought forward, which is 2015. Then balance carried down, which is 2016. Then here we are going to have profit and loss. Under profit or loss account, depreciation. You then add up whatever you have. All right. So this will give you the addition that you are looking for. So in 2015, we have 5942. In 2016, we have 6224 plus depreciation of 440. That gives us 6664 minus 5942. It will give us 722. All right, so this is another way to determine if additional non-current assets has been purchased. So we have addition, a cash outflow of 722 million. So I will then come here, additional non-current asset or capital expenditure. Let's call it capital expenditure. That is working number 2722. It's a cash outflow. Then we also need to determine if there's additional loans or the company has settled or the company has paid part of the loan borrowed previously. So let us go and determine that. Working number 3. We want to know if additional loans, So to do this, I will go back to the question for 2015 and also 2016. Remember, loans is part of financing activity. Therefore, in the question, we have short-term loan. How much is short-term loan in 2015?
1432.
4432. In 2016?
14, sir.
1432.
Oh,
143.
okay. 1432. In 2016?
1936.
1936. So in 2015, you are owing your creditors or maybe your bank, you are owing 1432. In 2016, you have borrowed more. So there's an addition, right? More cash has come in. Therefore, what's the difference between the two?
504.
504. That's additional loan. Now, we also have non-current liability, bonds. Okay, we have non-current liability, bonds. So in 2015, how much is the value of the bonds?
2,500.
2,500.
500.
In 2016, what's the value of the bond?
2,400.
2,400. So you have issued debts. You issued 2,500 debt in 2015. In 2016, it has reduced to 2,400. That means you have paid part of the loan you borrowed before. You have paid part of the loan you borrowed. That means cash has gone out. So the 100 is a decrease in your liability. Cash has gone out. That's a minus. When your liability reduces, that means you have paid back. So when you pay, your cash will go out. All right. So find the difference. That will be 404. Here will be 404. Additional loan. We have additional loan of 404. I don't need this total for each year. So I will then go up there. Additional loan. Working number 3. 404. All right. At this point, give me the total. That will give me the free cash flow to equity. What's the total? Yeah.
912.
What's the total? 912. 912. So that's the free cash flow to equity. So I can say the free cash flow to equity is 912 million naira. So that's 7 marks. You pocket it. You move to the next one. In the next requirement, you have to use the free cash flow to equity model to calculate the current market value per share, 5 marks. All right, so you want to calculate current market value per share. Number B, requirement number B, calculating market value, current market value. So before you can calculate market value per share, you need to first of all calculate the total market value. Remember, I told you to determine corporate value or enterprise value. There are steps you are supposed to carry out. The first step, after you have calculated your free cash flow, the first step is for you to determine the present value of the initial period. Step 2, you calculate present value to infinity. Step 3, you calculate total present value. That total present value will represent the corporate value, okay, or the enterprise value. That's all you need to do. It's not difficult. Therefore, I would then check from the question, this market value I want to calculate, what is the initial period? According to the question, initial period is for 5 years. All right. I think, where is that again? It's written somewhere. I think I noted it down. Let me see again. Yes, you are told in the last second to the last bullet points, you are told that the directors believe that the free cash flow to equity will grow by 18% for the next 5 years and by 5% thereafter. So growth rates, this our free cash flow. The current free cash flow of 912 million naira will grow by 18% for the next 5 years. So I will then come here, year 1, year 2, year 3, year 4, and then year 5. So free cash flow to equity, which is 912, this will then grow by 18% per annum. Let me adjust the number of years. So here is 1, 2, 3, 4, and then 5. Please, all of you mute yourself. I don't know who's doing crew there from the background. You are making noise. Please mute yourself. Let me see you. I only need you to on your mic if I need you. But for now, please mute. Your noise is distracting me. So I want to calculate I want to grow. We have calculated free cash flow to be 912 million. Therefore, we need to grow that 912 at 18%. So I would then say 1.18 multiplied by 912. That's 1076. Here is 1076. Whatever you have in your calculator, multiply by 1.18 equal, that's 1270. 1270. What you have in your calculator, multiply by 1.18 equal, that's 1498. What you have in your calculator, multiply by 1.18 equal, that's 1768. And for the final year, what you have in the calculator, multiply by 1.18 equal to 2086. Here is 2086. So with this, we have grown the free cash flow of 912 up to the 5th year. Immediately after this, we need to discount the free cash flow. So I would then say discount factor at, so I would then go back to the question. You have to use apple for apple. We have calculated free cash flow to equity, then you have to use cost of equity to discount it. So in the question, you are given cost of equity of 15%. You're also given a WACC of 12.5%. You cannot use WACC. You have to use cost of equity because you are calculating free cash flow to equity. So apple for apple. Free cash flow for equity should be used with cost of equity. You cannot use WACC because if you use WACC, that means you have included debt in your cash flow, and we don't have debt in the cash flow. So that's why we are using cost of equity of 15%. So I will then go back to my calculation. I need discount factor at 15% for year 1. 0. What? That is 1.15 raised to power minus 1.
870.
0.870. Year 2. Yes.
0.756. 756.
Year 3, you have to be faster.
0.658.
658.
Year 4.
0.57.
572.
Year 5.
0.497.
497.
So we need to multiply to get the total present value for the initial period.
Nine 93612.
936 point what?
Point 12.
It's okay. Rounding.
Year
Next.
2, 960.
960.
986.
986. Year 4.
1011.
1011. And then year 5.
1037.
1037.
37.
So we need to calculate total present value. Present value of year 1 to 5. Okay, present value of year 1 to 5. Add the 5 of them together. What do you have?
4930.
4930. That's the total present value for the initial period. We then need to calculate present value to infinity. I would then say PV after year 5 is year 6. Therefore, present value of year 6 to infinity, which should be computed as free cash flow to equity of the base year. In the question, we are given a growth rate of 5% after the initial period. So multiply by 1 plus G divided by cost of equity minus the growth rate multiplied by discount factor of the base year. All right, so move to the, oh, no space again. All right, let me manage this. Let me manage the space we have here. So PV of year 6 to infinity, which is equal to free cash flow to equity of the base year multiplied by 1 plus the growth rates divided by cost of equity minus the growth rates. Multiplied by discount factor of the base year. So this will be equal to, I will then go back to my table. Free cash flow of the base year. Base year is year before the current year. Year 6. Year before year 6 is year 5. So here will then be, this is your free cash flow of the base year, which is 2086. So here will be 2086 multiplied by growth rate is 5% after year 5. So that will be 1.05 divided by, we are given cost of equity of 15%. So 0.15 minus the growth rate of 5%, 0.05, multiplied by discount factor of the base year, that is 0.497, 0.497. So give it to me. What's the total? What's the total? 2086 multiplied by 1.05 divided by 0.1
Total answer.
equal
886 approximately.
10886. You then add it together. Add it up. Plus 4930. That's 15. 8 what? 816. So this represents the total present value. This is the total present value, that is market value. So that's the corporate value. Examiner now asks you to determine the current market value. I don't want to shift to the other page, to the next. Let me just manage here. Therefore, the current market value per share will then be equal to total market value divided by number of ordinary shares, which is equal to 15,816 million divided by 600 million shares. So what do we have here?
26.36 naira per share.
600 million shares. So you said it's equal to 26.36 per share. All right. So you can then say the current market value per share. So final answer, I would then say the current market value per share of Lamborghini Limited is 26 naira 36 kobo. That's it. That's what the examiner asks you to do. That's what the examiner asks you to do. So that's that. That's end of the question. This is where we are going to stop for today. So if I can solve 3 additional illustration, so that will be fine. All right. So but for now, let's call it a day.
Mr. Adejuwon, please, before you go, sir, can you just
Yep.
re-explain how we get our free cash flow for equity for requirement B? That's
How we got
10,
it?
yes, for year 1 to 5. I was lost in the
Okay, the
calculation.
incremental, yes, now, you have calculated free cash flow to equity to be 912 million, right? So the
Yes,
examiner now told you in the question that, according to the question, you are told that you should use free cash flow to equity model to calculate the current market value per share. However, examiner told you that the directors believe that the free cash flow to equity will grow by 18% for the next 5 years. So we have calculated free cash flow of 912 million. You are now told that it will grow by 18% for the next 5 years. So this 912 is the current market value, sorry, is the current value. Therefore, to grow it, remember, maybe you have forgotten under capital budgeting. All right, when you have inflation, it will be 1 plus the growth rate, 1 plus the growth rate raised to power n, isn't it? 1 plus the growth rate raised to power n. So in this case, our cash flow, which is the free cash flow to the equity, is equal to 912. So to do this, you just say our growth rate is 18%. 1 plus 18% is that's 1.18. So 1.18 multiplied by 912, it will give you 1076. What you have in your calculator multiplied by 1.118, it will give you 1270. You continue like in that order. That's how we got it.
okay, sir. Thank you, sir.
All right, then. You are welcome. Yes. Any other questions so that we can stop the class? Any other question? Okay, then. So in the absence of no further question, I want to say thank you to every one of you for joining the class. We are going to meet. We have one more class to end the diet. So when next we are meeting, we'll be concluding business valuation. Thank you, everyone. I will see you next time by the grace of God. Good night.
Thank you, sir. Good night.
All right. You're welcome.